Okay, so let's get kicked off. This is something that I want to talk about. Hopefully you can see my screen here. We're looking at the S&P 500 index. I've taken off the indicators. I've taken off everything. So it's a nice and clean chart. This is not, something that I look at. If I showed you what I look at, many of you that are not used to it may be a bit overwhelmed. So I've cleaned up the chart, removed some indicators, removed some moving averages, and just kind of showing you where we are, all right, in terms of 2019. 2019, as you can see, started off great. Okay, we had about a 28 to 30% increase in the S&P 500 benchmark. All right, after the big Q4 plummet in 2018. So to give you an idea where we've come from, okay, and so that we can relate, we have some benchmark. A lot of people are going to compare automatically to 2008. Look, this is a different market, okay? The Fed has already dropped rates 50 basis points just in the last week, just as a reactionary and precautionary method, okay? This is a very different market to what was in '07 and '08 when I started investing and where we had that housing and credit bubble, okay? This is a different kind of market. So let's not perceive 2008 to be what it is in 2020, okay? So keep that in mind. The closest area that we have to kind of compare to is 2018, end of 2018 to be specific. And over here, you can see that about peak to bottom, we had about a 19.7% drop, almost 20%. And if you've been paying attention to my post, you would know that a 20% drop from the highs dictates a bear market. Okay. This was not a bear market because A, it wasn't sustained. It could have hit 20%, and I wouldn't just classify it as a automatic bear market. Look at what happened, just following that last red candle, right? You can see that the market recovered very, very bullishly with a lot of momentum, right? And continued that way. If you would have listened to me back then and bought companies like Apple, Microsoft, Amazon, things that dropped 15 to 25%, okay? The index was down 20%. Imagine what stocks were down. And solid stocks, forget penny stocks and small caps. Companies like Amazon. Amazon was down about 30 to 35%. Same story with, something like Apple. There's countless of cases. Facebook had dropped significantly, I think closer to 45%. That's when they had also that Cambridge Analytica issue and all that kind of privacy concerns, right? So it dropped even more. If you would have listened and waited 1 month, you would have most likely made back about 30% return on most large caps. And that's the reality for 1 month, right? What the S&P 500 index has moved up in 1 year, you could have made in 1 month if you had listened and just gotten in around a reasonable time. Could the markets gone lower? Absolutely. Was it a reasonable time? Yes. Okay. The question everyone's asking now, is it a reasonable time now? Right? Where are we now? And let's take a look, right? Because I wanted to cover 2018 just as an example to give you a perspective that market drops, 10% market drops, 15, 20% market drops are not an anomaly. They are actually something that are quite common. We just get used to markets ticking upwards and dropping 1% and dropping 2% and moving back up, right? This has been the opposite in 2018 and of course now in the last 2 weeks, right? So here's what we're looking at from peak to drop, all right? Financial news outlets will tell you that the US market is down about 9% year to date, and that's accurate. That's right. Year to date, the stock market is down 9% approximately. If you would have bought on January 2nd, the first day markets opened, okay, this year you would, and just bought the index and held, you'd be down, 9%. Now, that's not how we calculate the bear market or correction level. We look at the highs, okay? And the high was in the S&P 500 was about 3,394, let's say 3,400, okay? The 3,400 index level. From that point, it's dropped to where we are approximately now is right about 13%. Okay, it did go as low as 28.52. I hope you can see these numbers clearly. And this is one of the reasons why I wanted you guys to use your computers, your desktops. I mean, if you use your phone, it's serviceable, but having the desktop computer there is a lot more important, a lot more beneficial, I think, for looking at these things. It's a lot clearer. So market's approximately down 13% from the highs, about 8 to 9% from year to date. Okay, where are we going from here? Well, I wish I could say we're gonna go down 5% lower, and then we're gonna move back up 20% and recover everything. I can't say that, right? I can't say that, and no one can. I don't care if they're Warren Buffett, they've been, trading and investing for 60 years, 50 years. No one can. All right. Ultimately it's just a guess. So it's my job to be reasonable, show you guys the facts, show you the situation, what my thought process is, and then let you decide. Guide, ultimately you're going to be pushing the buttons, you're going to be putting the money in, or you're going to be taking the money out. You're making those decisions. I'm not, right? My job here is to give you unbiased, unfiltered, accurate, and reasonable information for you to take advantage of. All right. So the market's down. What are we going to do? Right. We had a really good close at the end of Friday. This is something that happened the Friday past that as well. Okay. So we had a very bullish close. For those of you that are not familiar with candlesticks, I'm not going to do, a full candlestick breakdown, but ultimately these thin lines are where the index went to the low, right? That's the low point, right? You can see the high point there, right? 200, negative 250 on Friday should be a good sign. Someone says, yes, I mean, a good recovery, right? We were down a lot more, about 800 points in the Dow or something. And I mean, the points matter, but ultimately we also want to be aware of the percentage, right? So the S&P 500 on Friday, although the candle is green because it recovered, it's still down, right? It's still down from the previous day, right? About 1.7%. You can see on the right-hand side, okay? 1.7% and very close to what I've indicated here. If I zoom that in, you can see this gap, right? I'm gonna just use the drawing tool. That's the gap down, right? We're still down. It's the green candle. Again, this comes down to you being familiar with candlestick charts. So the market has really puked, okay? The market's really puked a lot more than I anticipated. I remember in the last webinar, which it was supposed to be, but the last Instagram live, I said, is the bleed out done? No. Can it continue to go lower? Yes. And that's what it did. Did I know it was going to drop, another few percent? No, I didn't know that specifically, but I did know that there is room to go lower. In fact, if we look at the big picture, you will see that we are now near, okay, about 2019 October, September levels. Okay, so this is where we kind of went right back, the index in terms of the markets. That's important to be aware. Where are we in terms of the market, right? Kind of erasing the last 6 months gain almost. Okay, going to about October levels. All right, so something to keep in mind. That's how you want to think. We're at October levels, right? It's not, oh wait, we haven't gone back to, a 2000%, 2000 point drop in the S&P 500. The S&P 500 hasn't halved. Okay, it's only down about 12% from where it was 2 weeks ago. Can the markets go lower? Simple answer is yes. Okay, I need you to listen to that, because people will not openly say that, and they will all fall into one camp, either extremely bearish and calling for 2008 every 2 weeks type of situation. And even a broken clock is right twice, right, a day. So there's that camp. Then there's the other camp, which will say, oh no, stocks are going up, constantly going up, the market's nothing wrong with it, nothing can happen, nothing can stop this, you know, so there's going to be extreme camps. My view is somewhere in the middle. Okay, my view is to take things the way they are, process it, and make a decision if it requires. I don't make decisions and tweak and do things simply because I need to. Okay, no, you want to make sure you react when the time is right. You don't need to just fiddle with your portfolio and buy and sell for the fuck of it. Okay, so understand that. You need to proceed based on your risk. Is there downside? Yes. Can market stage a recovery? Yes. So I don't want to be a cop out, but effectively what I'm saying is we are in uncharted territory. This is a lot of uncertainty. I don't know about you guys, but I haven't had to deal with a pandemic situation. I haven't had to deal with a major global viral outbreak. No matter how serious you think it is or how serious it's not, based on your personal views, the narrative is that it's global, it's spreading, there's more cases, there's more people dying. The mortality rate is approximately 3% last I checked. I'm going to share some stats with you guys on that as well. Okay, so that's enough about the S&P 500. That's enough about the US market. I want to now look at the different specific sectors. Okay, we've looked at the broader index. We want to look at specific sectors that make up the market. What do I mean by sectors? Right, the tech sector, technology companies. Right, you want to look at energy companies. How are real estate based companies doing? How are utilities doing? Right, how are financials doing? Banks. So we look at that, right, because these things are constituents of the S&P 500 index. And what I have here on my screen is the year to date, okay, line chart. I know there's a lot of lines. I'll explain here what's going on, but this is a year-to-date chart of the percentage move in each sector of the U.S. market. Okay, so I'll start from the bottom. Okay, XLE. What is that? That is the energy sector ETF. Okay, that's companies like Exxon and ConocoPhillips and Occidental, and you have a bunch of others that are energy companies that are listed in the U.S. and are U.S. based, and on average they're down about 30% this year. Okay, the sector is down 30% this year. That's a huge drop. Okay, conversely, if we look at XLF, what is XLF? The financial sector. Okay, that is down 17%. Okay, financials are down 17%. Remember, this is year to date. Where's the S&P 500? Down 8.45%. Like I said, right? SPY, okay, 8.45% year to date. Okay, XLV, what is that? That's healthcare. Healthcare is down, let's say, nearly 5%. So meaning it's still down, but it's outperforming the index. Okay, healthcare is doing a little bit better than the index itself, right, which is down 8.5%. XLK tech. Okay, tech isn't doing as bad as many people may think. I mean, you look at Apple and it's dropped. You look at Amazon and it's dropped, so on and so forth. There's a lot of larger tech names that have dropped, Facebook, so on and so forth. But it's not as bad as people think for now. Okay, could it get better? Sure. Could it get worse? Absolutely. Right. Then we have XLRE, real estate, right? Real estate. You have real estate firms, you have Reits, right? Real estate investment trusts, companies that have to do with anything to do with real estate specifically, not banks, but real estate specifically. All right. And look at that. They are about, let's just say, right at the break-even mark for the year, right? They've come down, but they're right at the break-even mark, about, let's say, down 0. Or they're up 0.73%, right? So flat for the year, which is comparatively great. Okay, if everything else is going in the gutter, but you have this remaining solid, that's actually a good thing, right? Conversely, look at XLU. That's utilities. That's the utility sector. Utilities have actually moved relatively up this year, okay? 5%. Compare utilities moving up 5% year to date and compare energy moving down 30% nearly year to date. Do you see that delta? You see that divide, right? So it's important to be aware of what's happening in a deep down view in the broader US market as a whole. Okay, so we've looked at that. Hopefully that also opens your eyes as to what's going on in specific sectors, which ones are completely decimated and which ones are actually holding firm. Okay, now let's move into individual, think of it like asset classes. Okay, so I understand that this may be a lot for some of you to take in, but I'll briefly go through it. Okay, top left sector, we're looking at the Treasury yield. Wow, right? Like just look at the drop in this as I zoom in, starting from 2020. Okay, what is the Treasury yield? This is the risk-free rate of return. The risk-free rate of return in Treasury bonds, like which is known as effectively as good as cash, as good as the most safest investment risk-free investment you can make, right? And you generate some interest on this. The risk-free rate of yield now via Treasury notes, U.S. Treasury notes, is about 0.71% annualized. If you put, okay, $100 in Treasury yield and left it there for a year, you are expecting to make 71 cents. Okay, let that sink in. All right, this is the market we are in. Was it like this in 2007 and 8? No, right? So people comparing to '08 1 to 1 are A, wrong, and two, absolutely fucking stupid. All right, that's some reality check there for you guys. Number two, right hand side. What are we looking at? This is light crude oil. What is that? The U.S. price per barrel. Okay, this is the futures contract. Someone said that the price per barrel is $42. Yes, $42, relatively speaking, was the last print for oil futures, but they have dropped a little bit lower. Oil futures are closed right now. They're going to open tomorrow in the evening, and there is some headlines that OPEC, the oil producing cartel, countries that are very heavily concentrated in the Middle East and they're oil producing countries, they effectively have come together and said, we're going to control supply and demand, okay, so that prices are stable for oil. And that's what OPEC is. Lately, the last couple of years, OPEC has also, brought Russia in, okay, because Russia is also a large producer of oil. And they said, okay, Russia, if you can join us and coordinate with us, we can also stabilize prices. If you remember back, 3 years ago or something, oil markets got decimated and the price per barrel went down to, about a low of $29 per barrel. Okay, 29 US dollars per barrel. That is significantly low. Like, let's zoom out here. Okay, the last time price per barrel was around $42 was in the beginning of 2019. Okay, so we've been here before. Okay, statistically, we can say this is a near, I would say, support, near a long-term support. Okay, take a look at how oil has been at 42 levels before, has also gone to $75 levels per barrel, right? So understand that, relatively speaking, if you are looking to buy oil, now is a reasonable time. Am I saying prices can't go lower? No, I'm saying we cannot tell the future. It's our job to make sensible and calculated decisions based on probabilities. This is all a probabilities game. All right. So let's look back to 2016, right here. 2016, I hope you can see that, was where oil was about $29 a barrel, right? Hit the low point. And before that, we had oil at about $100 a barrel, right? So take a look at this long-term chart. Okay. Hopefully this gives you perspective and something to think about. Right? I'm not going to tell you what to do. That's not my job. Okay. Like I said, I'm here to educate you, give you some insights and things that I look at. So if you are looking to get into oil long, meaning buy, now is not too bad of a time. Just note that, as I was saying, headlines came out not too long ago that, OPEC, Saudi Arabia, so on, they are a little bit upset because on Friday, Russia said they are not going to cooperate and cut oil production, right? The reason OPEC wants to cut oil production is because if supply goes down, this will stabilize prices per oil and perhaps make it more reasonable to continue at certain levels, because we already know demand in oil has come down. Less people are traveling, less people are, driving, less people are flying. Many countries, their manufacturing processes have slowed down. Many factories are shut down, right? So there's no doubt that there's a lower demand in oil compared to a month ago, right? So OPEC wanted to stabilize prices. Russia is comfortable with the current price per barrel, right? For them, again, every country is kind of looking out for its own thing. And Russia said, no, we don't want to cut supply. We need to keep our supply the where it is, because of course they want to use that to fund their running of the country and their treasury, right? So OPEC is a bit upset, and now there's talk that there's going to be an all-out, price war or race to the bottom, something similar to what we saw in 2016, which I highlighted, right? Am I saying oil is going to go to $29 a barrel? No. I do think there is more downside now. Okay. And for transparency, I am long, meaning I do hold oil, right, via ETFs. And I will probably buy more because the last week and a half to 2 weeks, I have been systematically buying as it gone lower, right? Why? Because I've been a long time oil trader. I have experience in the industry as well. So really, I'm comfortable buying oil as it goes lower. Is this the right option for you? Only you can decide that, because your risk tolerance, the amount of capital you have, is very different to mine, most likely. Okay, so I'm just telling you what I'm doing. Again, that's the disclaimer there. Okay, don't be surprised when futures open, where oil is traded on a futures contract tomorrow evening, that oil goes maybe below 40. Okay, so keep that in mind. Bottom left, moving on, gold. Gold. Gold, I was wrong about, because I thought, okay, this coronavirus stuff is going to maybe, calm down. It hasn't calmed down. Okay, so I was wrong about that. Number two, as a result, because there's some more fear, there's more panic, investors are fleeing risk, right? Why do investors put their money in the market? So that they can generate a higher rate of return. Because if you don't want to put your money in the market, what are you going to do for a relative rate of return? Put it in a bank account, put it in a CD, put it in treasuries? No, there's pretty much nothing you're going to make after you factor in a 2% inflation, right? So investors over the last few years have been chasing risk. This is why you also see stock markets move up, right? Because investors are willing to take risk to generate higher rates of return. What's happened now in the last 2 to 3 weeks is the opposite. Investors have started taking off risk and moving into assets like cash, moving into assets like bonds, moving into things like treasuries, even though their yields are next to nothing, simply as a safe haven. What's another safe haven? Gold. Okay, gold is also a safe haven. And I'm not talking about physically going out and buying a gold bar or something. No, gold as a financial product via commodity futures, via options, via ETFs. Okay, so people have speculated and put money in gold as a hedge, as a safe haven. And as you can see on the bottom left hand corner in the chart, you can see oil has rallied tremendously. 2019 was one of the best years for gold. This is the price per ounce. Okay, so right now, gold is trading at 1672, $1,672 per ounce. All right. I had a target of maybe 1,500 in gold price per ounce. It's moved against that, right? It's moved in the opposite direction, so it's gone a lot higher. Am I a buyer of gold right now? No, I think I'm okay not chasing this move. It could go higher, obviously, right? If markets continue to be fearful, if the economy does indeed slow down, okay, then of course people will continue to remove risk, and as a proxy, put money into products like gold, okay, and cash and bonds, right? Final thing here, bottom right hand corner, this is the US dollar index. It's not US dollar compared to other individual currency like the Canadian dollar or the euro or the GBP or the yen or the won. Okay, this is the index tracking the average of all currencies compared to one US dollar. And this is 0.96. Okay, it's a 96 cents. What does this mean? Just want to keep things on a relative basis. So where were we 2 weeks ago? At about 100. So $1, right? 1 to 1 on the index. Remember, on the index has dropped to 96. What is that as a percentage drop just in the last 2 weeks? Let's say about a 4% drop. That's big, right? That's big for currency, right? As a currency, it's a big drop, right? You can see here that the long-term trend, the long-term view of US dollar, right? It will swing between like a pendulum, right? Really strong they're really weak, and then somewhere in the middle, which is the average, right? Right now, the US dollar is retreated. I don't see the US dollar, going too much lower on the index. We do have a 2018 low of, about 90. So keep that in mind. It can go lower if investors and global participants think that the U.S. economy is going to be negatively impacted, they think, things are going to get worse before they get better, then you can expect the U.S. dollar to weaken, okay, which is what's been happening. It also didn't help that the Fed dropped 50 basis points on the benchmark interest rate. Okay, that's a big drop for one single meeting, right? Usually when they do drop, they kind of guide that they will in the future, and they drop by 25 basis points. This time they dropped by 50 basis points, which is 0.5%. Okay, so how does this affect the average person? It decreases borrowing costs on variable rates, whether you have a variable rate loan, whether you have an open loan, whether you're looking to get another mortgage. This decreases borrowing costs for lending products, loans, mortgages, line of credits, so on and so forth. Okay, so keep that in mind. Now, let's look at some statistics. I promised I would show you guys some facts, some data, and that's exactly what we're going to do. I hope so far that you found it, beneficial, what I've shown you. Again, I don't want to drag this. I also want to leave enough time for some ideas, and of course, some questions as well, right? So no fluff, no bullshit, straight to the facts, straight to the point. Let's look at some of those data points I was talking about. One sec, sorry. Mind my background there. All right, I'm just bringing up pictures here. So first thing, let's go over the US index, okay, in the long run, where we are. Okay, this is actually from a week ago. So, but still, the data is still relatively in place, right? So let's take a look at the long-term view. A lot of people want to look at, '08, right? Well, let's do that, right? Let's bring up '08 related chart here. All right, so hopefully you guys can see this. What are we looking at here? This is a line chart of the U.S. index, the S&P 500, which I've talked about, right, from 2007 to present. Okay, this is from about a week ago, right, so February 28th. And here we have the index dropping off leading up to October 2008, right? And then this is actually March. This is March. The index was down about 56.7% from the highs, okay? Closing high of about 1565 in the index, all right? So what's happened since then? You can see each little arrow here marks a percentage drop, okay, right? Look at the percentage drop I mentioned to you guys in end of 2018, right? 19.78%. Are you noticing a trend here? When markets drop in the near term, they set themselves up for a rally for the long term. All right, I'm going to repeat that because literally this is something you should write down and put on your table, put on someone you see all the time, put on their forehead so you can remind yourself what the reality is. If markets pull back in the short term, meaning they drop in the short term, whether it's 10%, 15%, 20%, 30%, I don't care. They set themselves up for a long-term recovery, all right? A lot of people in the end of 2018 said, Riz, recession's coming, 2020 recession, 2019 recession. Okay, this is back in Q4 2018, and the market dropped 20%. I said, look, the data I'm looking at, the economic data I'm looking at, corporate earnings, what CEOs are guiding, what CFOs are guiding, it all seems stable, it all seems solid. This is a technical sell-off, maybe an opportunity to buy. And for those that listened, fantastic. For those that didn't, they missed an opportunity because literally, stock prices, companies like Apple went up 50%. Companies like, Microsoft around there, Amazon, even more. We have things like Tesla that moved up double, right? 100% last year, and so on and so forth, right? So this is the cost of fear. Everyone looks at how much can they go down. No one looks at the cost of fear. No one looks at the cost of sitting on the sidelines, sitting on your hands and doing fuck all right? I cannot make it any more clear. I get very, very, let's just say, triggered when people say, "Oh, Riz, I'm sitting all cash." Grats, your money's worth less every day you fucking message me. Um, that's fine by you. Am I saying you go all in all the time? No, right? Absolutely not. Have some cash on the sidelines. Right now is a perfect time to build cash, to do something with it. Buy in systematically. Do you go all in right now on Monday? Do you go all in on a single stock or a single sector? No, absolutely not. Right? This is why I'm here. This is why I spend every waking moment of my days doing this. Because if you cannot do it at this level, right, then I'm not doing my job, right? I'm not doing what I'm supposed to. This is why people can rely on me. This is why people retain my services, come to me, and pay to have access, right? This is the harsh reality, right? 99.9% of the people are not capable of doing this, okay? For all you people that message me on Instagram, Riz, I want to be a trader, I want to do this. No, you don't want to be a trader. You don't want to manage money. You don't want to do any of this. You just think you do, all right? If you cannot give absolute 100% for every waking moment, you're not cut out for this, and that's the reality. What you are cut out for is participating in the market with the help of someone who has given their entire adult life to this. All right, so that's give you an idea of who I am, where I come from, and why when I say certain things, you don't have to listen to me. You can shut it down. You don't have to listen to me, but hopefully you get something out of it. That's the only thing I ask. All right, so the S&P 500 we know is up 400%. Okay, is up 400% since 2008. For all you fucking people that are sitting there asking yourself where the last 12 years have gone, this is where they've gone. Just in the index. If you would have bought something like Apple in 2008, well, fuck, I don't even know. It's like 600%, 700% return. Like individual companies have way outperformed, right? But just on an index level, it's up 400%. Ask yourself how big of a fucking moron you are if you were sitting on the sidelines the last 10 years scared to death, right? If you were, congratulations, you missed the fucking boat. You actually also missed the train, but so be it, right? And understand that when you operate on fear, you deserve to lose your money. Why? Because there's people like me who accept fear, we take on fear, we stand resolute. So if you are losing your money, I'm making money. Okay, you deserve to lose your money. Okay, this is the absolute harsh reality. I'm not here to pander to anyone. I don't care what political affiliations you have. I don't care how sensitive you are. I don't care how old you are, your gender, your race. I don't care how much money you have or whether you pay me or not or retain my services. I live to be transparent and say what I feel, and that's exactly what the case is. All right, moving on. Where are we in terms of the index and how it's looking on overbought or oversold level? Meaning, have indexes, have the markets moved away from the average? Have they moved away from rationale, right? So here's that screen coming up. I apologize if it's a bit blurry, right? But here we are, okay? Take a look at this. That blue line, if you can see, is the price of the S&P 500, the index, the 500 index, and the 50-day moving average. The 50-day moving average, along with areas of extreme overbought, meaning extreme levels where people are optimistic and indexes have just been going up and up, and extreme oversold. Okay, obviously we're an extreme oversold. So when I say we're oversold or overbought, it's literally, think of it like like a seesaw. Okay, you're either really high up or you're really low, and that's where we are right now. All right. Keep in mind what's low can go lower. All right. So is the market going to go to zero? Absolutely not. Right. If the market goes to zero, that means we have a bigger problem. That means is the world is ending. Okay. So I actually got that question not too long ago. What would I do if the stock market completely imploded, went to zero. I said, well, there's no point at that because at that point, death is probably imminent. We maybe got hit by an asteroid or something and it's all going under. Okay, so for someone who asked me that question some time back, that's a fun answer there for you. Another thing I want to show you now, moving into some further data, looking at earnings, okay, earnings estimates for the future. We know CFOs and CEOs give guidance that, hey, my XYZ company in the next quarter, this is how we think we're going to do, right? And now I'm going to show you visually what that kind of looks like, right, in terms of a line graph for the S&P 500 as an average, because we know there's 500 US-based companies that are tracked as part of this index. Here's the average, okay, of earnings estimates for the future, okay, ranging from December 2019 to now in this little kind of orange yellow box. Look at where we are. Do you see a meltdown in earnings results going forward yet? I don't. I mean, I don't know what some doomsday callers are looking at in terms of the corporate side of earnings, corporate revenues. All that stuff hasn't come down yet. Could it in the near future? Yes, we'll have to wait and see. We know airlines have decreased their guidance. That one is for sure, right? Obviously, people are going to be traveling less right now. They've already cut traveling, and that's going to impact them for the little bit of the future until things turn around. And that could potentially be summer, maybe further, right? I'm not a disease control expert. I'm not a virologist. I'm not like any of those things. So I don't know how long this thing lasts. Okay. But from a standpoint of where we are right now, corporate earnings guidance have not been pummeled like people think. All right. Now, last chart to do with market stuff before we move into more coronavirus stats. Okay. Because I said I would show that and I will. So bear with me. This is the U.S. non-farm payrolls. What does this mean? This is the payrolls percentage change. Okay, payrolls come out about this payrolls data that comes out, I think, every couple weeks or something. So we can see the long-term, right, payrolls, right? Our payrolls going up. If we see U.S. payrolls going up, that means there's more demand in the workforce. The economy is healthy. People are getting paid a little bit more for the job that they were doing or are doing comparatively to a few years back, right? And that's what this line, this chart shows. Ultimately, it may be a little bit simple to you or a little bit complex. It doesn't really matter. What you want to look at is 2008. What was happening in 2008? Huge breakdown in payrolls, relatively speaking, right? People were losing jobs. Employers were cutting jobs. Employers were cutting pay. You can see why that's a problem. Right? And that all happened in the wake of 2008 in the financial collapse. Look at what's been happening since 2010. And look at where we are now. Do you see anything similar to this? Does this happen in one day? Does this happen in 1 week? No, we're not there, right? We're not there. The payrolls data is always a lagging metric, but it can give us some insights. And this is from February, so not too long ago. I'm not pulling up stats from last year, pulling up stats from literally a week to 2 weeks ago. Okay, so this is where we are. I think the next time this chart is updated, we're going to see a little bit of a tick down, maybe. Okay, remember, it's a lagging indicator. People are not changing, the dollars they pay per hour at work because of coronavirus. Okay, they're not changing that immediately. That will take a sustained impact if people find that, okay, you know what, if companies find that I don't need to pay this person anymore because we don't have enough sales to justify the position, that's going to affect that, right? And that takes time, right? But where we are right now, you can see if we start seeing a deterioration in payrolls going forward, then we reassess. But it's my job to show you the hard, cold facts. We have not broken down in terms of economic indicators, all right? So that's me on record telling you at this point on March 7th, okay, the economic data is not justifying the sell-off that we had. Again, it's a fear-based, it's a risk-off situation more than an economic situation. Remember, the economy is a little bit separate to the market, Okay, bear market doesn't mean the economy is trash. A dropping economy for a short period of time doesn't mean we're going to have a bear market. So you understand how they're both similar, but they also move separately. Okay, this is a complex topic that I don't have time to go into in detail. But are you guys ready for some of the coronavirus stats? Okay, just give me a yes. I just want to make sure you guys are all awake and I haven't put you guys to sleep. Right on. Okay, great. Sorry, I'm just having some tea. I need that if I need to do what I do. With that said, okay, continuing on. I'm now going to show you guys a couple charts based on coronavirus data, and this is actually data from today. Okay, so no, I'm not cherry picking shit from last week or something like that. This is real time data from March 7th today, and it's maybe delayed by an hour or two, but that's just fucking close as we're gonna get. Okay, so here we are in terms of coronavirus cases globally and deaths. Can you guys see this? All right, just give me a yes if you can see this. Great, perfect. I need to check because sometimes screen share goes off haywire. I'm talking to myself here. Okay, so here you can see the global coronavirus cases about 106,000 right now. All right, it's higher than what it was a week ago. Do you understand what I'm saying now? Can this number go higher? I'm willing to wager it will. Okay, if I had to put my money on cases going up, I would wager they will. Okay, does this automatically mean the higher the cases go in proportion the market drops? No, right? But the reality is this data set is saying that the cases of coronaviruses are increasing. Okay, does it mean that, oh my God, the world's ending, it's game over, the markets are going to zero, or this is how it's going to impact the election? Not one-to-one. There's no one-to-one correlation just yet. Let's take a look at a more important metric, deaths. About 3,500. And I said earlier, the average mortality rate is about 3% globally. The mortality rate, unfortunately, I don't want to scare you guys, in the US is actually higher. Okay? So just keep that in mind. Again, I'm not trying to stoke fear, but this is who wants to know my number for the percentage of people who get coronavirus and have died in US. So the cases we know of in the US and the cases that have, people that have died is actually higher than 1%. Dan, someone in the chat said, 1%. It's actually higher, right? So ultimately, yes, people are saying 6 people. There's actually an increase now. There's more than 6 people that have passed. In terms of percentage-wise, it's higher than 3. Okay, and that number will change. Okay, it's actually closer to 20 deaths now, I think. Okay, and of course, it's important to look at the age breakdown as well, right? There is no denying that older people with respiratory problems, people that have underlying issues in terms of their immunity, their immune system being compromised, or they were very unhealthy already before because they had surgery or they were in the hospital, or they were if they have cancer or they are on chemotherapy. These things of course will impact someone's ability to fight off this infection, right? So in terms of age group breakdown, John asked me about age group. Yes, you can look at this. I've shared this before. The current numbers will likely be a little bit different, but ultimately, if you're above 65 to 70 and higher, and you have an underlying condition, you have a higher rate of not recovering from this. Okay, but continuing on with the current recovered rate, 58,000. What are you seeing from this? That the recovery rate is actually really good. Now understand, Okay, some people think, oh, 50, about 55% or 50% have recovered from this. Um, yeah, that's true. But remember, there's another 50,000 or 48,000 in the global cases that we don't know what's going to happen. Those are a question mark. Could they fall into the recovered category, or could they fall into the debts category? That's how you need to think on a critical thinking perspective. Okay. Now, moving forward with the last chart or data point I have for the coronavirus stuff. Here we are. I hope it's large enough. Here we are in terms of, sorry, here we are in terms of, here we are. Okay, active cases versus closed cases and total debts compared to total cases, okay, on a linear scale. Ultimately, what you need to understand is total cases are increasing, and of course, as a result, total cases of debts are also increasing. Okay, this is not a surprise. Just be aware that the recovered rate is very high. There's a lot of closed rates. There's also about you know 3 to 6% rate of mortality, depending on where you look at. Okay, in the globe, right? So that's some stats, right? That's some stats from today. Okay, and in fact, you can see even the graph lower calculates the beginning of March, right, in terms of debts. So I hope you guys kind of got a little bit more perspective in terms of what I look at in terms of the coronavirus stuff, in terms of the markets. Um, be aware and be cautious of who you listen to, where you are gathering your information from. I'm an investor, I'm a swing trader. So for me, knowing what's happening in the broader market is important. For someone who's scalping or like trying to go against algos and make that one tick or 5 cent, price change in a stock or in an option is very different to what we do. Okay. So be aware of that. Okay. I am a market strategist. For me, as a portfolio manager, as someone who's been on the institutional side, I look at things differently than your average Instagram trading guru with his rented Lambo. Okay. So my last and final thought on this is be careful who you listen to, be careful where you get your information from. In fact, be careful and question the information. In fact, question what I say, right? Go out and maybe double check it, or go out and do your own due diligence, right? It's important to do that. And I'm not protected from that either. I don't tell you guys to just say yes, yes, shake your head. That's not what I'm looking for. I'm looking for people to, think critically, to grow their knowledge and double check and verify and then make calculated decisions. Okay. So absolutely, verify, check all this stuff, do more research, look into it. And if you have questions, you can always ask me, right? You can always reach out to me. Again, I'm not a scientist. I'm not a medical professional. And even though I know many in US and in Canada that are dealing with this stuff, boots on the ground, right? That are dealing with this stuff day in and day out. So my thanks to you guys, whether you're on the webinar, whether you're watching later on, for doing what you do, because it's quite the situation, right? Now, ideas. I said I would give you guys some trade ideas. Now, first one being Boeing. Okay, I'm going to give you guys trade ideas first, and then we'll get into Q&A. Okay, because I don't want to hold out. I know some people are probably wanting to know what opportunities there lie, and that is Boeing. Boeing is a fantastic opportunity, but for long term. If you're trying to get in and you think you're going to make a ton of money in the next 2 3 weeks, main trade may not be for you. Okay, you may need to carry this for a few months and longer. Okay, if there's further downside in the market, understand that Boeing will continue to drop, right? Airline sector has already been, let's just say, for lack of a better word, annihilated, right? So who is Boeing going to sell their airplanes to? Airlines, okay? And of course, the whole 737 MAX situation, didn't help from last year, and the continuation of this also doesn't help. But fundamentally, valuation wise, there is some great upside in the long term for Boeing. Another thing you want to look at, another couple of companies you want to look at are in the cruise lines. Now, cruise lines are like a swear word right now, right? Okay, you mention a cruise line, and it's like, holy, the first thing you think is coronavirus line instead of a cruise line. So this is the long-term chart for CCL, okay, Carnival Corp. This is a cruise line. They run cruises, operate many cruises, right? And obviously, unless you've been living under a rock, you know that there have been many cases of individuals coming back from a cruise line to the country of origin, and they have cases of coronavirus because everyone's packed in on this. Obviously, it's a big boat, big ship, but it's like its own little country at that point when it's on sea. So things spread, and as a result, they've gotten hit because no one wants to go on a cruise right now and for the foreseeable future. So the market has discounted this thing insanely. It's way undervalued. Is it going to turn around tomorrow, next week, and continue? Maybe not. Okay, maybe it has some downside, but you want to put this on watch. You might want to consider taking a position long if it suits your risk tolerance and you're able to hold on for a bit. Okay, you might need to hold on to pain. All right, this is the nature of what we're in. My tolerance for pain, I'll tell you right now, is ungodly. Okay, I don't say this to over exaggerate. My level of pain tolerance is beyond the average person, or maybe I would say even beyond this, the top percentile, 1%. Okay. That's the area I play in. That's me. I'm not expecting everyone to be that way, and it's fine if you're not. That's okay. My situation is different, but I'm telling you who I am and where I come from in terms of my pain threshold, whether it's financially or otherwise, is very much different. So in this case, you need to be aware that even if I'm buying a ton of this right now, that doesn't automatically mean that you go and pile into this. Okay. I haven't taken a long position on this for transparency. I have taken a call option on this. And if you're not familiar with options, I'm not going to go into options right now, but I am taking a bullish stance on this. Okay. Ultimately, everyone's going to have an opinion on what they buy or what they don't buy, what they think is a good point to buy, or what the fundamentals are, or what the technicals are. It's all at the end of the day kind of subjective, right? I'm lending based on my experience. I'm lending based on what I see on the chart, what I see in the global market, my risk tolerance, and my capital. If it's not suitable to you, that is also fair. Okay. Another idea that you may want to look at are some solid REITs, right? There's one that I'm going to show you here for the long term, and it has a great yield, meaning a great rate of return. Even if you hold this thing for long term, this has potential to pay you while you hold, right? And the yield for this is approximately 8% annualized. Brookfield Property Partners, this company, Brookfield, is a Canadian asset management company. It's huge, one of the largest asset management companies in the world. And they operate in many different countries, in many different areas, whether it's real estate, whether it's infrastructure, whether it's utilities, all that stuff. So this company is tremendous in terms of its stability, in terms of its track record. It just beat down, obviously, because of the overall market. Is coronavirus going to impact their properties physically? No, right? So it's a great opportunity if you have the staying power. If you are scared money, if you're fearful, and you want to pay your bills next week with this money, don't bother. Okay, so just keep that in mind. Next, I'm gonna give one more trade here. In fact, let me bring it up on my phone just to confirm. Yeah. Okay. This one you may or may not be aware of if you have been following along. This is Enterprise Product Partners. I'm still bullish on this. It's dropped a bit since the last time I mentioned it, and that's fine. This has a great yield. It's one of the best pipeline companies for natural gas, oil, right? All that stuff's still going to be needed. It's still going to be transported. Pipelines don't get corona. Sure, the business may be impacted based on demand from other businesses because these pipelines go to other, facilities, other storage facilities, other production facilities. And if that's shut down and slowed down, sure, it will impact them. But at these prices, the yield is great. It's about 6 or 7%. So yeah, nearly 8% now, right? Similar to Brookfield, where if you hold for 1 year, you're going to make 8% total, right? Just in dividends. If the stock price goes up, well, that's capital gains. It's even more, right? So I like that. Again, it's a solid company. Financials are great. This isn't some fly-by-night company. Okay, so that's my take. Again, I know there's some questions. I apologize if I haven't answered them. Like I said, you'll have the chance to ask me in a moment. So I've given you guys three crucial, easy, and solid medium to long-term, I would say suggestions on what to look at or buy. Okay, one being Brookfield Property Partners, the other being Enterprise, and the one before that I brought up Carnival Corp, which is the cruise line. Okay, so I've given you three. I'm not saying go out there and just buy them on Monday. Okay, again, I hate hand holding. I hate doing things for people, but what I will do is give you my insights, and it's up to you to either take it or leave it. Okay, now the final part of this session, I don't want to drag it too long, we're now at the hour mark, is the Q&A. So what I'm going to do now is bring up the questions area. Okay, so what you can do is, if you're on here, I'm not sure if it's going to show up on the mobile, but you may see like a Q&A button in the chat area, right? And you can ask a question in there, okay? And then I can see the question list. Let me know if that works. If it doesn't, you can also click ask a question at the bottom, right? There's a little question mark button, right? You can either chat or you can ask a question. So type in your question there. I'll see it in the question list, and then I can answer. This saves me from scrolling all the way up, okay, and trying to filter through while others wait. Okay, so ask your question in the question area. Just press the question mark button. Let me know if it works. If it doesn't work, then we'll move without. Someone asked in the public chat, maybe the Q&A is not working, but either way, let's continue with this. Is it true that one of the fourth largest bondholders imploded on Friday? Honestly, I don't know. I have not heard of that. We do know bond prices, bond yields, especially junk bond yields, have gone berserk, obviously for obvious reasons. Have they gone under? I don't know. Who is the fourth largest bondholder institution or bond trade? I don't know. Okay, I'd have to verify that. So another question asked by John. What's my take on CLX as both as defensive and a stock that will produce good numbers on disinfectants? Yeah, Clorox is great. Clorox is great. I mean, it's been great. Of course, it makes more sense now in terms of how they will do. Let's bring the chart up here. How are they going to do in the future? I mean, take a look at the market already factoring that in, right? The stock market has dropped. Majority of stocks have dropped the last 2 weeks. This thing has moved up. Why? Because disinfectants, all that kind of stuff, demand has gone up and the market has priced it in. Do you want to buy at these levels? That's a personal choice. Do I hold any? Not right now, not currently. Will I be adding? Most likely not. I don't like to personally chase these kind of trades because of a catalyst. So I won't be chasing. And this applies both ways, right? I don't like to chase per se downside. I just like to buy at opportune moments. But I also don't like to, buy when things continue to rally, and then me trying to continue this trend, right? That's momentum style, and it can work for active trading, but for something more medium term, I don't really like that style personally. Um, Another question by David. Do I see any correlation with a huge drop shortly after all the brokers decided to go commission free? No. No. This is increased liquidity, meaning there's more volume. If I had to, make a wild guess, there's more volume because people are not worrying about commissions like they used to. But is this impacting the markets? No. What it's doing is there's likely more retail people, meaning there's more mom and pops, there's more 18-year-olds, or more 20-year-olds on Robinhood, people on Reddit, social media, they're just getting into it. So there's more mom and pop retail traders and investors. And what can happen is they're a very small relative percent compared to the broader market on a dollar basis, right? So can that move prices? Of course, it can move prices a bit, but it's not going to make too much of a difference. The small, college student doesn't have large enough of size to move much pricing, even if he, panics and sells out, right? It's not going to make too much of a difference. Now, if there's a hedge fund or, let's just say a trust fund for, like just say a hedge fund or any mutual fund or institution, a college endowment fund or university endowment fund or anything like that, and they start liquidating some of their positions and very quickly, without taking, different risk measures in place, then yes, prices can drop big time. So no, it's not the individual commission-free type of mom and pop trader, um, making a difference to this. Someone's asked me, the vast majority of daily candles on the SPX are generally small, less volatile. There have been large green candles lately. Are smaller daily candles a sign of market calming? Absolutely, right? Do I look for this? Not on a candle basis. I, in my head, can look effectively visually without looking at candles. The average move of the S&P 500, the average move of the S&P 500 over the last 2 weeks is actually higher than 2%. That's a 2 sigma change. For those of you not well versed in stats, that's a 2 standard deviation change, right? The average move in the S&P 500 per day, okay, is less than 1%. So if it's higher than 2%, this is a doubling of the average move, thus a 2 sigma event. Okay, this is the average, right now. It's funny because I was looking at statistical average price moves per day just yesterday. I didn't think to capture that data and visually share it, but I mean, I'm just telling you what I was looking at verbally. So to answer your question, do I look at candles and then how large a candle is or not? No. Do I factor in uh, price moves? Yes. Like how, if we're seeing large moves, of course, as a proxy, we know there's increased volatility, right? There's more whipsaw, there's more uncertainty, there's more fear, right? So absolutely, yes, we're in that kind of area now. Do I simply start buying when candles start looking like this? Not necessarily. Not necessarily, because you can have tremendous opportunities to buy or tremendous opportunities to short even on large intraday moves. Okay, hopefully that answers your question. Someone asked me, what do I think about, what is this SPS IOP? I don't even know what that is. I don't even know if that's going to show up here. Okay, so it's just an industry, oil and gas sector ETF is what I'm guessing. Yeah, it's moving with energy, right? It has to do with pipelines, oil and gas. So, preferably just look at XLE. Okay, just look at XLE, right? And I touched on this in the beginning. XLE is down. The sector is down, nearly 30% year to date. We have companies like Exxon, XOM, absolutely battered. Okay, just beginning of the year, and even in 2018, 2019, they've been dropping, right? Let's take a look at 2019 onwards, right? Take a look at 2019 onwards, right? Sorry, I had to bring the chart here. Okay, going lower, right? Energy's been going lower as oil prices have kind of stabilized around the 50 level, and they've just fallen out of favor, right? Everyone's jumping on the solar and renewable energy train, so that money's got to go somewhere. It's coming out of traditional energy based companies and going into maybe others like solar and you know electric and all that kind of stuff. Okay, that's something to consider. Someone asked me where they were from earlier. Yeah, so you can look at. I mean, I source these from different data providers, right? So there's a few you can look at. There's DSHORT. That's an institutional advisor website. A lot of the stuff will go over 99% of the people's heads, but if you want to look at that, sure, you can look at it. But I utilize many, right? You can look at many news outlets like, think of it like Bloomberg that report data, right? I'm not saying you got to follow their headlines, but they do report certain data. So you can use that. You can use finviz.com for certain data sets like pricing of commodities, pricing for individual companies, so on and so forth. Okay. Hopefully that answers your question, David. Is there any other questions as I go in here? One second. Yep, Bill says there's news on Zero Hedge. Yep, Zero Hedge is there also as well, and they lift that data, right? Zero Hedge lifts data from some of these data providers as well, right? Of course, Zero Hedge is a lot more of a very, very conservative, a very, very doomsday, and very, very bear, uh, like bearish outlet, financial news outlet, if you want to call it. So just be aware of where they lean. Okay. Someone asked me, let's see, do I discuss penny stocks? No, not worth getting into. There's millions of penny stocks, and they're penny stocks for a reason. Some people um, who are experienced can trade them and do decently well. 99% of the people are just wasting their time and money. Um, that's a fact. In fact, the SEC has even said, on average, a middle-aged person getting into penny stocks loses on average $50,000. Of course, it depends on how much they start with, but with the average person losing $50,000 on penny stocks, of course, someone who's middle aged, that doesn't bode too well when markets have been, going up steadily, right? So that tells you that if you're speculating, if you're actively trading, you better be trading the right product, the right stuff. Otherwise, your chance of losing money is quite high. So that's my personal viewpoint. Any other questions? Do I trade the TVIX? Yeah, so yeah, I mean, I monitor the VIX, the volatility index. Do I just specifically trade that? Have we placed a trade on the VIX via ETF? You mentioned the TVIX. We've traded the VIX. Why? There's different ETFs for the VIX, right? There's UVXY, which is leveraged. This is the VIX index. This is the volatility index for those of you that are not familiar. This goes up if there is fear in the market. Think of this like the fear gauge, right? And you can see if I bring out long term where things were in 2008. Okay, on the index level. Okay, you do not hold the VIX for long term or any ETF that tracks the VIX for long term. Okay, it decays, it goes down. I'm not going to go into how optionality and futures contracts rolling works for these, but ultimately, you use the VIX you buy as a hedge or as a speculation if you see a massive, increase in fear. And yes, people can profit from fear, right? This is one direct way. Do I hold any right now? I do not hold any VIX related product right now. In fact, what I will likely do is the moment I see things turn around and calm down, I will be shorting volatility, aka going against the VIX and riding this sucker down. Okay. Another question. Biggest mistake when I first started out. Fuck, I've made so many. Made so many. I should write a book. Sorry, I can't give you anything specific, but not, not having someone to learn from. And mine was a different situation because it was 2008. The original iPhone was just released. There was no webinar platforms like we have now that were readily available. Facebook wasn't even listed as a public stock. There was no such thing as Instagram. I didn't have access. Is that my fault? I don't know, but I wish I did have access to someone. In this day and age, there's access to many people. Most of them, you get access to clowns. It's your decision to make that call, who you follow, who you have access to, who you listen to. Um, okay. John asked me, is XIV still out there? The SIV, or the opposite of VIX, actually imploded, but there are new products out there that are inverse volatility. So yes, you could buy the inverse of volatility, or you could try and outright short the VXX or VXY or the TVIX. Okay, hopefully that answers it. Um, do I? How do I feel about GM? Someone asked me, how do I feel about GM and Ford? I don't like. I'm a huge car guy. Um, if I wasn't doing this, I'd probably be going around the globe racing different tracks. But I do not hold any automotive manufacturers, whether it's Ford, GM, Daimler, Fiat Chrysler, whatever. I just don't. The margins on many of these companies are very low. Of course, we know that the automotive industry is in kind of a shift based on what people are looking for product wise. Um, you know, I'm not a fan. I think money can be used elsewhere instead of buying auto manufacturers. Okay. That's my take. That's my personal opinion. Someone is typing, so I'll let the final last questions come in. I don't want to drag it too long. Um, yes, John, they could implode, but the VIX, what happened when the SIV imploded, meaning the opposite of the VIX, the inverse of the VIX, it was a different type of it. That was the first time volatility exploded upwards after years of calm. So institutions and even regular traders thought, you know what, this is free money betting against the VIX because it just doesn't go up. It just keeps going down. They thought it was free money, and that's where institutions got caught with their pants down. And when institutions get caught with their pants down, they have to liquidate. They either close, they either go under, or whatever, regulators step in. And what happened was this happened in a very large way. So as a result, people paid the price, right? In fact, when the volatility index imploded, I remember I had SIV, or the relation, like what was close to it, but they decided to shut down that product, right? So when they shut down that product and there's no liquidity, you're fucked. You can't even sell. It's worthless. There's nothing there. So could that happen again? Not after. I mean, it could, but if we were at 2008 levels, but I doubt it's going to happen now after the VIX has moved up, from 18 to 41. Volatility's already spiked. So you're okay with betting against volatility if you have the stomach. I wouldn't just do it now because this thing could very well pop 10, 20% this week or in one day. I wouldn't short now. I said I would go against it once I'm confident this whole coronavirus stuff has tapered off, markets have calmed down, fundamentals have now come in play. Right now, fear is in play. Okay. Wow, so questions coming in. Will I be buying into clean energy companies in the next couple of years? Maybe, I don't know, like, maybe I'm biased, I don't know, but of course I've been invested and traded and have exposure to the classical energy market, which is oil, right? So yeah, I mean, if I have to switch gears and start moving into more electric, uh, electrical, solar, renewable types of products and companies, yeah, I'll make that switch, right? Okay. Any final question, guys, before we wrap it up? I do want to thank all of you for coming. I hope this is what, you came for. You found it to be worth your time. You found it to be insightful because, hey, this is a passion. This is a labor of love for me. I could be doing anything else. I could be doing anything else on a Saturday evening, or Saturday night. But I choose to do this because um, this is what I do. This is what I enjoy and interacting with people, and seeing, if we can combine our heads and work together and have fun doing it. That's the reason for me. All right. Again, thank you from the bottom of my heart for everyone that came. This session has been recorded. I mean, if you're here, you've watched it. If not, then, maybe you're watching it afterwards. Either way, stay safe out there. Not trying to say that it's the end of the world. Please take things on a very face value perspective. Okay. Anything I say, anything everyone says, take it as a face value. Don't, panic or bring emotions into it. Look at things for how they are. I think in this day and age, it's very important for people to be trained to think critically. And everyone thinks, oh, critical thinking, I can think. I'm a human being. I'm grown up. I'm an adult. Yeah, but you'd be surprised how many people lack the ability to think cleanly without being swayed by outside interference, by outside people, things. And many times it's the internal that affects people's decision making. What is that? Emotions, right? Fear, greed, all these things, right? So it's hard. We're human beings. We're not robots. So we do have, I have emotions too, but being aware of them and trying to make sure that you are factoring them in to your decision making will help you no matter what you do, whether it's a relationship, business, stocks. If you're aware of your emotions, you will be better suited to make better and more critical decisions when the time comes. Okay, thank you everyone for being on. Thanks for your time. Thanks for your trust. Share this once the video goes up, the recording goes up. Support us. Support us on YouTube. Support us on Instagram. Do what we can because I'm not the only one. There's a team behind this. We put a lot of effort, a lot of energy into this. This is really something we take seriously. I take seriously. I'm answering messages 2 o'clock in the morning. People ask me, Riz, do you even sleep? Are you a vampire? The answer to that remains to be seen. So with that said, again, have a great rest of the night. Be safe out there. Happy investing. Stay tuned. And, if you have the opportunity, if you're not a part of our elite membership, please consider joining. There's enough ways for you to join. There's website, there's our social media there. If you look, you'll know what to do if you want to join. Okay. So thanks again, everyone. Have a good one.